Oracle, the boring database company your dad invested in, just posted 84% cloud infrastructure growth. It has $553 billion in contracted backlog, and it's building the physical data centers that power OpenAI. The stock is down 54% from its highs. Wall Street says it's worth double from here. So what is everyone missing? Oracle spent decades as the enterprise software dinosaur that cloud-native investors love to ignore. Then the AI build-out happened, and Oracle's second-generation cloud infrastructure turned out to be exactly what the market needed. The headline partnership is OpenAI's Stargate project. Oracle is building the physical data centers in Abilene, Texas, that train OpenAI's most advanced models. Multiple buildings are already operational. This isn't a press release partnership, it's real concrete and real GPUs. Q3 fiscal 2026 revenue hit $17.2 billion, up 22% year-over-year. Cloud infrastructure revenue surged 84% to $4.9 billion. That's an acceleration from 68% the prior quarter. Cloud isn't slowing down, it's speeding up. But the number that should stop you cold. Remaining performance obligations hit $553 billion. That's contracted future revenue. It jumped $68 billion in a single quarter. New commitments from Meta, Nvidia, and others piled in. Oracle now has more contracted revenue than most companies generate in a decade. So why is the stock at $143, down 54% from its September highs of $346? Two words: capital intensity. To fulfill those contracts, Oracle needs to build massive data center capacity at enormous cost. The company plans to raise $45 to $50 billion in fiscal 2026 alone, through a mix of debt and equity. It already raised $30 billion through bonds and convertible preferred stock, with a record oversubscribed order book. Free cash flow is negative $13 billion over the past 12 months. That's not a typo. Negative $13 billion. Oracle is spending far more than it earns right now, betting that the contracted revenue converts into real cash flow over the next 3 to 5 years. The margins tell the same story. Renting out Nvidia GPUs generates thinner margins than selling software licenses. As Oracle's revenue mix shifts toward infrastructure, profitability compresses, at least temporarily. And the debt is now above $100 billion. That's real leverage on a company in transition. But here's what the bears might be underestimating. Oracle said most of its large AI contracts don't require additional fundraising. Customers are either prepaying for GPUs or supplying their own hardware. The capital intensity sounds scary, but the contract structure is actually de-risking the build-out. The company just guided fiscal 2027 total revenue to $90 billion. That's massive growth from the current $65 billion run rate. And cloud revenue is guided to grow 46 to 50% in Q4 alone. Larry Ellison, who basically invented enterprise software, is now using AI code generation to build more applications faster with fewer engineers. Oracle is cutting costs while scaling revenue. If that flywheel works, margin expansion follows. Wedbush's Dan Ives called the earnings a huge relief for the entire tech sector. Analyst consensus target is around $280, roughly double the current price. So what's the chaos capital take? Oracle at 143 is a company with $553 billion in contracted revenue, 84% cloud growth, and the OpenAI build-out in its backyard, trading like the market doesn't believe it can deliver. If the backlog converts, this stock re-rates violently. If it doesn't, if margins stay compressed, free cash flow stays negative, and the debt becomes a problem, the downside is real. This is the ultimate show-me stock. The contracts are signed, the data centers are being built. Now Oracle needs to prove it can turn backlog into cash. At 54% off its highs, with consensus at double, the risk-reward tilts in your favor if you have patience. The boring database company is now building the physical backbone of artificial intelligence. The market hasn't adjusted yet. The question is whether you adjust before it does. The capital markets are chaos. Embrace it, and I'll see you in the next video.